Hey guys, Domenic Nesci here. Today I am with longtime friend Theo Chambers, Shore Financial. I was just saying to you a second ago, mate, congratulations on all your recent success. Your business has been growing. It's been around for what, 10, 11 years now?
8 years. We celebrate our 8th anniversary last week.
Wow.
Yep.
And huge numbers. Are you the biggest in the industry, or what's?
We're the largest independent in the industry. In those 8 years, we did 16.9 billion in applications, which was a record for someone in 8 years, you could say. Number one independent brokerage for the last 4 years in a row. We're hiring and growing. We're being as innovative as we possibly can in terms of technology and making sure we have a point of difference to consumers compared to the traditional mortgage broking model.
And look, I actually see and follow a couple of your brokers online. It looks like all your guys are more than just brokers.
Yeah.
Financial strategists, they understand the property market, they're well versed on a number of different things. They're not just...
Yeah, spot on. So we try and make sure our mortgage brokers are more advisors. We have a very relationship-driven model where the broker builds a long-term relationship with the client, similar to what you would with your accountant, right?
Yeah.
So you're going back to speak to that one person. A lot of the new age mortgage brokerages, they break up the chain into 3-4 sort of points of contact throughout the process, which means the consumer doesn't really have a relationship with anyone in that organisation. We want to maintain the fact that the consumer feels like they have a relationship with someone at the business.
That's definitely a point of difference, and like everyone out there, today's podcast is not about promoting Theo's work and his business, but it is important what he's talking about, because all of you out there that are looking for a mortgage broker or someone to help you with financial affairs, that long-term relationship is vitally important, especially when you're establishing that strategy. A lot of newer organizations are moving towards digitization and trying to get computers and technology to do all the heavy lifting because it's cheaper. But I think that this is a better way to do it, people to people.
We still also try and use computers and systems and programs and processes to do a lot of that heavy lifting. We have a CRM system that's automated a lot of the process. We're trying to implement that where possible, but then without taking away the fact that someone wants their hand held by a physical person through the process.
Agreed. Get computers to do stuff that is autonomous and boring, and get people to work with people.
Yeah, well, you've got to also realise buying property are the biggest transactions people make in their lifetime, and they probably only make a handful of them. So they don't want a system or a software to tell them what to do through those processes.
I when you said that, it reminds me of a quote, and everyone bloody quotes Warren Buffett, but he says when you're investing, you pretend you've got a 6-shooter gun. You got to make each one of those shots count. So if you're going to take a shot, make sure you know what you're doing, you've got the right people around you and the right support system to kind of do this thing properly.
I really like that. I'm going to use that one.
All yours. I'll tell Warren about that you're going to borrow it.
Yeah.
Mate, the reason why I like having you on the show is because you are one of the biggest independent brokerage firms out there. I feel like you got your finger on the pulse, you're kind of ahead of the curve, and you understand what's happening in the market. All of your brokers and all your team and all your clients are informing you what's happening and what people are thinking, feeling. You kind of get a sense on how much lead flow is coming into your system as well. And that kind of is an early sign on where the property market is going. But then also, I feel like you talk to a lot of big heavy hitters and industry representatives and understand what's happening with the government policy and what's happening with the banks and credit. Would you be able to just talk briefly about a market update?
What's going on, what's happening? Yeah, look, I think the last time we got together was almost a year ago. It was right as the COVID hit, lockdown happened, and everyone thought the world was ending. And for us at work, definitely in April, sort of May, everyone just sort of paused. The whole market just paused and didn't know what to do. Once they realised the world wasn't ending and things looked maybe like an opportunistic time to buy, then the market took off. We saw then 3 RBA rate cuts, 3 cuts of the cash rate, which is now making it 6 in total in the last 2 years. There's not much more to go as well where the current cash rate sits at. So I can't see another cash rate cut coming, and there is discussion of negative rates, but I think where we're at right now is probably sustainable. On top of that, look, there was obviously the attitude that the government gave to the banks around pausing your repayments. It was a bit of a government initiative that the banks then owned and took on board, and said, yep, if you want to pause your payments, let us know. Everyone sort of jumped on that bandwagon without actually really being in financial sort of difficulty or strife, you could say.
Yeah, I felt like a lot of people around me thought this was free money time, or...
Well, yeah, the banks were really accommodating with it. They didn't need to, some banks did want to see that, have you lost your job or something like that. But most banks, you could just apply for it, which was so different to what happened in the GFC, right? In the GFC, when a bank got wind of a potential risk with you defaulting on your mortgage, they would come in and start negotiating with you and look at basically making you sell your property. Now it was, let's get through this together. Let's not make you sell. Let's just add as much debt on top of your debt as possible, and let's talk about it in the new year, which is where we are now. And people did do it in a reasonable manner, in the sense that, so I think it got to about 10-11% of total housing loans were on pause at around April, May last year.
Yeah, makes sense.
But by October, so not long after, a few months after, it dropped back down to 3 to 4%.
And is that like a normal rate, or was it the normal rate?
No. It was below 1% prior to that. Mortgage arrears was very low.
Okay.
And arrears has been steadily dropping for a good 5 or so years prior to that, because rates have been dropping. We've seen a downward trend in interest rates for a good 10 years. So arrears has also been dropping with that.
That's interesting, because one of the massive concerns and things that question that I was fielding at that time is, hey, what happens when the market blows up? GFC, the banks are going to take assets, huge amount of supply is going to come into the market, whole market's going to tank. Look at how many people are taking advantage of this, delaying our mortgage repayments or stopping them. This is a clear indication that there's too much debt in the system and people can't afford it. The whole market's going to blow up. Blah, 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 blah.
Yeah, I've heard that doomsday spiel, you could say, several times. From
8 years, you'd hope so, huh?
Yeah. A lot of people have been talking about how it's a debt-fueled economy. And yeah, look, there's some elements of truth to that, definitely. However, debt in America is how America sort of rallied out of the GFC.
Yep.
It provided huge growth in their share markets. It provided a powerful economy, and it just look at their economy now. They're at all-time highs. It was a scary sort of time last year, but it was exactly what they said, in the sense of that V-shaped recovery. The market crashed, but then recovered straight away.
It was a shock to the system.
It was a shock to the system, because it was literally like the Hollywood movie of, is the world about to end? Are we all going to die of some deadly virus?
I remember sitting up at 2 a.m. watching all these scary videos about the Black Plague. And thinking, Charlotte, fuck, tomorrow we're going to go buy all the frozen veggies.
Yeah, I did buy some frozen veggies, and I
think they're still in the freezer.
Yeah, I watched that Outbreak and Contagion movie.
Yeah, all the worst case scenarios came. I was terrified, but I have to say that during that time I did keep a level head, and I did help clients buy some investments and set ourselves up. Were you talking to many people that during that scary time were buying assets, or were a bit kind of aware of what they were in? Yeah,
so lots of people. We had record amounts of people sort of from June, July onwards start inquiring to get pre-approved to get to the property market, because once they cut the cash rate 3 times, it made it very appealing for people to go buy. Also, with the volatility that we witnessed last year in the share market, people probably felt more secure and safe to buy property. It's something that doesn't crash as aggressively as the share market did last year.
Yeah.
And I feel like the working from home arrangements that everybody adopted made people put more emphasis on having a nice home. So people were looking to renovate or upsize. Huge amounts of refinances, probably double our normal volume of refinances, because the media was big on pushing the fact that you should, check your current rate and look at refinancing. Fixed rates dropped to 1.8, 1.9%. It's funny, actually, with the last 2-3 rate cuts, RBA rate cuts I'm talking about, most of the banks, in fact all of them, didn't move their variable rate at all. They didn't pass on any discount to the standard variable rate. What they instead did was just really slash their fixed rates.
That's interesting.
So that 0.1 funding that the government basically pledged to all the major banks and saying, get this out and support the economy with it, that pretty much went straight to their fixed products. Now, the reason I believe they're doing that is because churn with clients and, people refinancing and swapping banks is at, all-time highs with everything going on. And I think consumers are just more aware that you need to constantly look at your current mortgage and look at refinancing every 2-3 years. So
is that an opportunity? So sorry to cut you off, but is that an opportunity in the market where someone getting debt should look at fixed rates? Is that something that we should be doing?
Well, that's what I'm saying, that the major banks are saying they'll take a lower margin on fixed rates. They'll put you on a much lower rate to secure you for 3-4 years, so you don't refinance in a year or two time, and the cost of establishing the loan is pretty much washed in the face of the 1-2 year transaction, right? There is an opportunity if you are committed to keeping your current property and your current mortgage for 3-4 years. Fixing for 3-4 years right now is definitely quite opportunistic in terms of very attractive rates.
And where do you see the mortgage market going, or financial products or instruments, or do you think that there's going to be a bit of it's going to be harder or easier over time to get more debts? And
great question.
Yeah.
So a lot of people have got this misunderstanding about there's a big change coming with responsible lending. It's going to be a lot easier to borrow money. The change has already happened. It happened probably, it was around July 2019 when APRA dropped the assessment rate from 7.25 to a margin above what you actually pay. Okay. So it was a flat 7.25%, but then they said, you know what, we're just going to make it 2 to 2.5% above what you actually pay. So as rates go down, your borrowing capacity goes up. So that's already been in place, like I said, for almost 2 years now. And a lot of the stuff that happened in the Royal Commission in terms of us having banks and brokers having to really scrutinise bank statements and go through credit card statements and verify living expenses, that's already sort of come a little bit unstuck as well, that you don't have to scrutinise statements as much anymore. Some banks don't even need the statements anymore. So a lot of the...
Is that because of open banking, or is it because they're more transparency with data, or is it because they don't really care or need it?
Well, they're taking... So the change that's happening this year in terms of responsible lending is they're going to put more of the burden back on the consumer, right? So if someone takes a loan they can't afford, instead of always scrutinising the bank and the broker who might have written the loan in the first place like they did the last 10 years, it's up to the consumer to declare to us their accurate living expenses. If they're telling us their living expenses is $4,000 or $5,000 a month, we'll take it on board as that's $4,000 or $5,000 a month.
Does that mean that there is a bit of an issue brewing? Like, do you think that
there's still the guidelines and minimum amounts we have to abide to in terms of APRA and NCCP and all that? So we still, have a minimum assessment rate we need. We still have minimum living expenses we have for a single applicant or dual applicants with 2 dependents. So there's still minimums. However, there's less burden on the broker or bank to verify these minimums meet, what they're telling us or whatever it may be. And
does that mean that if these regulations do come into play, responsible lending does get peeled back, there will be a greater access to debt for the average consumer?
That's my point. That greater access to debt has already happened. It's been in place for the last year or so. And as interest rates are coming down, your borrowing capacity has been subsequently increasing. So, but
more so with less paperwork. Like, for instance, if I had crazy spending habits, now I don't declare those spending habits.
But they will still, basically, if you've got crazy spending habits, you can probably hide that crazy spending habit more easily these days. But they still will put a minimum based on who you are. If you're a de facto, if you've got children, that all still gets factored in as a minimum requirement.
And I got to say, I don't know what your opinion on this is, but I feel like that is prudent. I feel like that makes a lot of sense. Like, if I'm an adult, just because I've been spending one way up until this moment doesn't necessarily mean that I'm not going to change my spending after.
Well, especially if you're committed to buying a property, right? You're going to be naturally stressed yourself about the transaction. You're going to be looking at your rent you're currently paying. Let's say you're renting and you're moving into an owner-occupied purchase. You're going to be looking at what rent you've been paying, what your mortgage repayments are going to be, and if there's a major difference between the two, you're going to be concerned about having to make up that difference. On that note, though, the major difference between most people who are renting and the interest what they would pay on buying that property is a lot less. That's why there's a lot of people buying property at the moment, because it's cheaper to buy the property and borrow the money than it is to rent it.
Yeah, and do you think then with that last statement, the property market is going to have much of a change this 12 months? All the economists are talking 30% over 3 years and all sorts of crazy numbers. Do you agree with any of that?
So I had a bullish view towards the property market the moment they started cutting the interest rates last year. You know, even though, without naming names, certain very high-level bank executives were predicting and forecasting huge
15% drops.
Yeah, up to 30s. You know, one person said. Ironically, some of those people I know for a fact were looking at properties themselves. They, whilst they're saying the property market's coming up 15 to 30%, they're out there looking at, you know, huge luxury houses themselves.
They're going out to auction the following weekend.
Maybe it was a tactic to scare off the other buyers, but and they quickly retracted that comment within 3 to 6 months, and they changed their forecast, and they now believe that there's some good growth in the property market the year ahead. We've had good growth already. I believe the median house price in Sydney has surpassed what it was pre-COVID.
Yep.
And in the next 12 months, I personally think it's going to be a great year in the property market.
Double-digit growth?
I think we could hit double-digit growth in good sought-after areas.
Yep.
You know, it's all about supply and demand. Areas where there's not a huge amount of supply, which is generally the whole of Sydney. There's not a huge amount of supply much in Sydney, just because it's quite hard for developers to add huge apartment blocks anywhere, really.
Approval ratings and stuff are down,
yeah.
Though they are starting to come back up. But even though the approval ratings are starting to come back up, it's still a 24-month lag anyways.
Yeah, they
sometimes
can't
more.
And they can't keep up with demand. The supply of housing compared to the demand of housing it's just an endless chase.
Okay, and we're talking a lot about the market. We anticipate that debt is relatively easy at the moment. It may be getting easier with responsible lending. We feel like property market, because I agree with you, is going to rally over the next 12, 24 months. I do anticipate double-digit growth. Now, for the people that are there, they're like, listen, we're convinced, we want to buy property. There are a number of different structures that are available to us. I just wanted to talk about some of those with you and what the differences are, what they mean, and strategically, how does that impact a purchaser? The first question I want to ask you is really around first home buyers. Mm-hmm. People in their mind think that the average first home buyer is like a 23-year-old, tradie or something.
I've got good stats on that.
Yeah. So we know that that's far from that.
So in Sydney in particular, the average first home buyer is 39 years old, mm-hmm. and 40% of them are buying with dual income, as in husband and wife or de facto couple buying together.
Very different to what people expect a first home buyer to be.
Yeah. I think in other areas of Australia it's lower age, but the Sydney market in particular, it's just so expensive to enter. So it's hard to do it on your own in terms of one income, and it's hard to do it at a young age.
And may I ask, if you're a first home buyer, and let's just say you're a first home buyer and you're going for some of the first home buyer benefits from the bank, mm-hmm. From the government, does the story that you tell the bank and the government have to be the same? And what I mean by that.
This is a
contentious question.
Yeah.
Now, the reason why I ask it is because I've had people say, hey, this is going to be my first home, but I will turn it into an investment property. And I don't want to be paying, say, principal and interest versus interest only.
So the government, I believe, is quite open-minded to those type of conversations and those scenarios, right? I think they're religiously going through every single transaction and first home buyers grant they've given out in the past and making sure the person's living in the property. I believe, correct me if I'm wrong, it might have changed, but I believe the qualifying metrics is that you need to have lived in the property for 6 months at any period within the first 12 months.
Correct.
So in the 11th month, you can move in for 6 months.
Yep.
They just want to support, someone feeling like they have a roof over their head. It is the Aussie dream to buy a home. It's very Australian to be focused on buying a property. In America, for example, people aren't as focused on buying a property and having the roof over their head. People are more content with renting.
Certainly not in the UK.
I was about to say, same in Europe. It's people are happy just to rent. So here, the government supports it, and the incentives are stronger than ever. It's just about finding a property that you can qualify for those incentives with.
And how do the banks respond to that? So when I'm saying I'm using my first homeowner's grant, does that then mean I have to do P&I, structure it as my own home debt? Or could I go and feasibly buy my first in home but turn it into investment, but therefore get investment debt?
It's very case by case. That's a good question. Technically, if they want to see that you're applying for the first homeowner's grant, they want to see it being able to be serviced on a owner-occupied basis, which is also then a P&I basis. It's hard for, these days, the banks are very reluctant to give a interest-only loan to an owner-occupied borrower. You need to have a really good reason. And yeah, you can, in some situations, try and get that 12-month rule over the line to factor in rent, but it's a challenge.
And is it, because I remember buying property a while ago and it was great because you could go get 90, 95, almost 100% interest only. Are those days coming back again?
Great question, actually. I was just about to say when you mentioned that there's definitely more accommodating lending policy coming out, right? So low doc loans have come back and they're very competitive. A low doc loan is someone who hasn't got their financials sorted, or their financials might be a bit all over the place with written off expenses and whatnot, and they can just put down a 20 to 40% deposit, not worry about having to have attractive financials and submit tax returns to get the loan approved. A healthy deposit. They used to charge a risk fee, which is basically called an establishment fee, once off fee up front of about 0.5 to 1%. They've waived them at the moment, so there is no establishment fees for low doc loans for some banks, and the rate used to be 5 to 6% about 5 years ago. Now it's like 3.4.
So that's awesome. I didn't know that. So low doc loans are coming back. They're making it easier for you to get in, and also they're reducing the rates of competitive, not loan shark levels. Yep,
they've waived the establishment fees and they've dropped the rates. Even other things like 90 to 95% loans with no mortgage insurance for professionals that are low risk, like doctors, any medicos, accountants, lawyers, engineers. If you've got a good story about someone who's clearly on a good career path, you could probably get that over the line with the bank to waive mortgage insurance and lend at high levels.
That's extremely important note there, because that can cost you tens of thousands for LMI, lender's mortgage insurance. And if you've got but a career that the government or that the banks approve, they'll waive tens of thousands of dollars for you.
Yeah, at some of the levels I've seen, it's more than tens of thousands. It's over $100,000. I've seen banks in the last 6 to 9 months do things that I've never seen them do in the 11, 12 years I've been in broking. It's crazy what I'm witnessing at the moment. Even the way they'll accept verifying income. Normally they've had a very black and white policy of looking at the last 2 years, either averaging the two or taking the lower, depending on what bank. I've got clients right now that I'm dealing with that we're annualizing current year-to-date income. It obviously needs to be a good sought-after profession. For example, anaesthetists and anyone in the medico industries, they absolutely love.
Okay, for all the anaesthetists, I was brave of me to even say that word.
Yeah, it's a tongue twister.
So they can annualize your current the amount that you're writing month to month.
Yep, I've seen people join the industry just after finishing their specialist training. And within their first year, the bank hasn't even seen a full financial year tax return of income, and they'll take the current year to date annualize. And that current year to date might be 3 or 4 months income, which they'll annualize.
That's awesome.
Yeah.
And So if I'm getting a sense that it's almost, we're going back to early 2000s lending criteria where they're starting to look at giving away a bit more investment-centric debt, because that was kind of not on the books for a long time.
If you can just put a case forward that makes sense, right? There has to be some numbers that they're working off to come to a certain assumption or calculation, right? You can't just say this person's going to earn X next year because I believe they will. You know,
right.
You have to forecast an earning or something like that based off some form of information you have. But they're making exceptions that they wouldn't in the past.
So this is where it comes into play, where, you know, you actually have to have a good loan writer.
Yeah, you really need someone that actually understands how the banks look at things and view things and will consider exceptions.
Is that the big difference? Aside from the fact that, you know, a broker can take you to any bank, the ability to sort of write the loan, like what the story is and how you explain who this candidate is, and you're fitting the regulation for each of those banks?
Yeah, well, look, KYC is all about know your client, you know. That was introduced years ago, and it's, you know, I think the level of work that goes into your summary notes has definitely increased in the last 5 years. That's been going on for a while. You know, when you submit an application, you really need to have some detailed notes about their career, their employment history, their job security. You know, even the new changes coming to your credit report and credit sort of reporting and Vita files in terms of your past history of repayments on any credit facility you have. You know, it doesn't need to be, in the past it used to be that your credit report was based on times that you've really gone into arrears and it's been marked as a default. Now it'll just note late payments, as in you could be just a week over on one credit card statement.
Shit, you're scaring me.
Yeah.
I'm thinking back, have I done any bad things in my credit report?
So now it's filed for as long as you've had those credit facilities. It'll summarise all the times that you've been late on payments, even if it's a few days.
Shit. Well, mate, I want to ask you, I know that you're hiring, you know, 10, 20 staff, your business is growing, so I don't want to keep you away from that because I'm sure you're doing heaps of interviews and stuff. But I wanted to ask you one more question, very important. Are you buying something this year? Are you buying any more property this year or next year?
I am looking actually to buy a property. I've sort of ironically tapped out of borrowing power in my personal name because I don't really sell anything. I've never sold a property. I've only bought. I am now looking at an investment in my super because SMSF lending is also becoming a bit more feasible. That's actually not 100% true. There's less lenders doing it as opposed to 5 or 10 years ago. However, the 1 or 2 lenders that have come into the market offering it are offering really attractive terms at the moment.
Okay.
You can get up to 80% and low rates.
That's something we might have to talk about. And so you're looking to go and get a property, drop it into your
super.
SMSF.
Yeah, well, I just feel the big, you know, super versus property versus shares within your super. The difference is, you know, your whatever cash balance you have in your, or just, you know, balance you have in your superannuation. If you put it, you know, in the share market, you're aiming for 5 to 10% growth, right? But if you use that as a deposit on a property, and let's say you go buy something for $850,000 or $1 million, you're actually aiming for 5 to 10% growth on the property value, of which 80% is borrowed money.
Much larger number.
Much larger number. You're looking at making 5 to 10% on the bank's money.
Yeah, it makes a lot of sense. I actually did a whole video on that just the other day. I completely agree with you. And may I ask, not to ask too many questions, but what kind of property are you looking at for your SMSF?
Well, I'm big on houses and land. You know, I want to try and find a property that is in a R2 zoning where you can hopefully subdivide. It's hard to find that. You need, you know, between the 13 to 15 metre frontage. It's very limited areas that you could do that, or they're not limited areas, it's just limited opportunity out there because everyone's been thinking like that.
Yep.
I'm not opposed to strata, but I've got strata investments, and I feel like I'm trying to diversify, and I now feel like I'm at the level where I could comfortably make take the risk, you could say, to do a construction development like that.
Okay. Good. I'm glad to hear that you're back out there. You've got a couple of properties and you're still investing. I'm in the same boat as you. Thank you very much for your time today. I really appreciate it. We'll have to get you back on the show again, ask you 1,000 more questions. If any of you have questions for Theo, for myself, please reach out. Theo's on all the Instagram and Facebook and maybe even a TikTok account. I don't know. I haven't seen it yet. And Theo's at Shore Financial. Reach out if you have any financial related questions. Please if you liked anything, share, subscribe, all that fun stuff. And we'll see you all soon.
Thank you so much.